Hello, this is Bob Steele. In this video, we will be talking about rental property. Objectives. At the end of this, we will be able to explain how income and expenses are recorded for rental property and explain how to report personal use of rental property. So let's take a look at the tax equation first. So once again, this is our tax equation. Started with the gross income, deductions above the line deductions, deductions for adjusted gross income, another way of saying that, equals the adjusted gross income less the greater of the itemized or the standard deductions minus the exemptions gives us our taxable income times the tax rate or the table gives us our gross tax liability. Then we have to have the AMT, if there is such AMT applicable to the tax return. That will give us our tax liability after AMT. Then we're gonna compare that to the credits and the payments we have coming up with our tax due or refund. So when it comes to rental property, we are going to be up here again in gross income. That's a little bit deceiving because that's where we will be on the 1040. But just like with business income, which was recorded on a Schedule C and had business income and expenses recorded on it, the rental income will be very similar. You would think it'd be reported on the Schedule C because it is a business type of activity. But because there's a few things that are different, we actually record that type of business on a Schedule E, and it'll be similar in regards to the Schedule C business income in most other regards, meaning that we are going to have rental income, the money that we received from the renters, plus minus the expenses. So there will be expenses involved in the calculation of the rental income. Then the net income or loss will be reported and brought over generally to the first page of the 1040 here. So notice that the fact that there could be a loss brought over, and that's the same for the Schedule C income, that there could be a loss that we would then be put into the gross income area, which is a little confusing, so keep that in mind that could happen. The losses is going to be one thing that we're going to treat a little bit differently, so that's one of the reasons that we have the separate schedule, which we will talk about here. Reporting rental income. Income and expenses are generally reported on the Schedule E. So once again, rental income is similar to business income. It's a kind of a type of business, but we're going to report it on Schedule E. There's a couple things that are going to be different on rental income, and one is going to be that we have this issue of passive activity. So the IRS basically came up with the idea that rental income in some cases could be passive activity, and therefore they may limit the losses. So it's very possible when we buy rental property, if we're going to buy expensive, a rental property that costs a good deal of money and then depreciate it, and that in the first few years we could have substantial losses. And the IRS is going to be concerned with taking those losses against the rental income. So that's one issue we'll talk about a bit. And the other issue is what happens when we use the property for both personal use and business use. So if we bought a vacation home and we use it for both a vacation home and we rent it for part of the year, then what do we do with the allocation of the expenses in that case? And if that is the case, we could very well end up once again with a substantial loss. And the question is, how do we deal with the loss? Is the loss going to be allowed, or is there going to be limitations on the loss? So ordinary rental expenses. Now, if we were looking at the Schedule E, the Schedule E is going to have rental income just like it always would. That's going to be how much we received from the renters, basically on a cash basis for the most part. And then the expenses are going to be just what you would expect an expense to be. Just like in our accounting classes, basically anything that we use in order to help us generate revenue in that same time period is going to be an expense. And in the case of rental property, normal expenses would be repairs on the home, the management fees for rental property, advertising for it, depreciation, which of course is the devaluation of the allocation of the cost of the property over its useful life. Notice that the depreciation could be quite substantial. We also could have mortgage interest on the loan on the property, which could also be quite substantial. So especially in the first few years of the property, it's very likely, very possible that we will have a loss on the property. Rental property depreciation. So remember what depreciation is. We're basically going to depreciate or allocate the cost of the property over the useful life of that property. So if we bought a property solely for rental usage and we paid $300,000 for it, then we would allocate the expense or the deduction of that $300,000 over the useful life. And remember, we had different ways of doing that in accounting. I mean, ideas of the ways to depreciate are something like the straight line method, the double declining method, and we got to determine how many years to depreciate it over. For tax purposes, they basically just tell us what we're going to do. So they say for rental property, generally going to use the straight line method. If it's residential property, we're going to depreciate it over 27.5 years. If it's non-residential property, business type property, it's going to be depreciated over 39 years. And we're generally going to use a mid-month convention. So if we bought property for $300,000, then, and it was residential property, we would basically take that $300,000 divided by 27.5 years. That's how much depreciation we would have each year that we could expense and reduce our rental income by. And we also have to account for the mid-month convention, meaning that no matter what month we purchased it in, we're going to assume that we purchased it in the middle of the month. So if we purchased it on March 2nd, we're going to assume that we purchased it in the middle of March. And so that we could just not have to allocate the days. We don't want to break it down to the days. We're just going to say it was bought in the middle of that month. So, and obviously in the second year, it'll be just the 1 year of depreciation. So that's how we're going to allocate the cost of the building over the useful life of it in the rental property. So rental vacation homes. So now we're going to talk about an issue of what if we don't just use it solely for rental property. If we bought a home and we just use it for rental property, fairly cut and dry there in that we can just allocate all the expenses to the rental property. But what if we use it partially for rental and partially for personal? The personal use of the home is not deductible. The rental use of the home is. So the place where we're going to have an issue here is not on the revenue side because the revenue is what it is. Whatever income we received from the tenants is revenue to us on the Schedule E. But the expenses are going to have to be allocated between the expenses that were used for the rental and the expenses that were used for personal. The expenses that were used for rental we get as deductions to reduce our rental income. The expenses that were used for the personal aren't deductible. And so now the question is, well, how do we do that? And what are the rules for a property that is both vacation and rental property? Property used for both personal use and rental activity is either primarily rental, primary personal, or personal rental. So first thing we're going to have to do is break it out between these three categories. The first category is basically what we want. We'll kind of tell you why that would be. It depends on the number of days rented, basically, and we'll take a look at that. So primary rental property, if we're going to use it for both rental and personal, this is basically where we want to be. And if we look at it, we're going to say a rental property that is used more than 14 days, no more than 14 days for personal purposes, or 10% for total rental days, whichever is greater. So basically, if we had the vacation home, we're probably going to say, well, we don't want to be in there for more than 2 weeks of vacation, and the rest of it will be allocated to the rental. And if that's the case, we can call it a primary rental property. How would we deal with the primary rental property? Well, the income, once again, is just what it is. The income is whatever we received from the renters, basically on a cash basis for the most part, will be reported as income. The expenses, on the other hand, is we're going to have to allocate between both personal use and the rental usage. So we're going to do that with a ratio, and we'll do it basically comparing the amount of rental days compared to the amount of total days usage, and we're going to use that ratio to allocate the expenses between the business usage or the rental usage and the personal uses. And then we have this loss. So if there's a loss is allowed against other income up to $25,000 if it's considered primary rental homes. And let me give you a little story on this just to see the background of the kind of thinking that may have been taking place in terms of coming up with this $25,000 loss that would be allowed. Remember that business income, if we lost money in the first few years, there's no limit on the loss. We get to take, if we lost money on the Schedule C, we generally get to take it for the most part against the W-2 or other income on the first page of the 1040. In terms of rental property, the IRS at some point came up with the idea that rental property is many times passive, and I think they had the idea that wealthier individuals were taking advantage of rental property losses by basically having rental property, and that rental property could be completely managed, and they might be holding on to that rental property basically for the increase in the capital in the capital of the property, meaning they're hoping that the value of the property goes up. So it's more like they're holding on to it for an investment so that the value of the property will go up, and in the meantime they're renting it with the expectation that they're probably going to have a loss, and then these substantial losses are being taken against their ordinary income. And the IRS would have the argument of saying, well, that looks like passive activity. You're not actively renting. You're not actively involved in the business. Therefore, it should be subject to passive activity limitations, basically meaning that we're going to limit the number, limit the losses to the passive activity income. So for the most part, generally, the idea being that you could deduct the expenses only up to passive activity income, but you cannot deduct it against the other income. You also can generally, for the most part, roll it forward. So if we had a large loss this year, and then next year we had income, passive activity income, then generally you can take the loss that we had this year and roll it over and deduct it next year if we had income, passive activity income. That would be generally the idea. Then, of course, real estate professionals, people that are involved in real estate and do actively participate and are in the rental business, basically would think that basically said that's unfair to us because we are actively rental professionals and it's not basically passive activity to us. And so therefore the IRS basically said, well, if you're a rental professional, then we'll basically allow the deduction. If you're actively participating in the business, meaning you're kind of involved in the management and actively involved in the rental process, then we'll allow a deduction up to $25,000, subject to passive activity laws and an AGI limitation against your personal income. And that's basically kind of the compromise that came up. So they came up with this arbitrary $25,000 that would be allowed. So primary personal use, we basically don't want the primary personal use to end up happening, because if we have the primary personal use, then the idea is that we don't get the expenses. We don't get to write off the expenses. But of course the income as well, we would generally not have to report. The idea on the IRS side on this one would basically be that if the home was rented for a very few amount of days, then the rental income would be small and insignificant. And the expenses, of course, if they were allowed, would be greater than the income, resulting in a loss. So that, therefore, the IRS is just going to say, well, you don't get the expenses, you don't get to take the loss, and you don't even have to report the income, because we're going to assume that it's immaterial, and we're going to assume, of course, that the expenses are greater than the income. Therefore, it's kind of a waste of time to do so, because it would end up in a loss. We're not going to allow the loss. So then if it's personal/rental homes, this would be the case that, remember that in the previous scenario where we had primary rental homes, they had to rent it for no more than 14 days. Well, not use it personally for no more than 14 days. Well, what happens if they use it personally for more than 14 days? Then basically it's going to be personal/rental. And if that's the case, we have the same allocation, basically meaning that income is what it is. Whatever we receive from our tenants is income. Expenses still need to be allocated, meaning we're going to allocate between personal use and business usage, or rental usage, which is a form of business usage in this case. But the expenses are deductible only to the extent that there is rental income available. Therefore, we're not going to get this big $25,000 kind of deduction that we would then get to deduct against our ordinary income. And notice again, especially in the first few years, it's very possible that we're going to have these losses that we would like to deduct against, the personal income. So that's going to be the difference there. So we are now able to explain how income and expenses are recorded for rental property and explain how to report personal use of rental property. Thank you.